Everyone, my dear daughters and sons, as we promised earlier, we thought of coming with another lesson in the syllabus. This is 13th lesson, unit number 13, ratio analysis. Unit number 13, ratio analysis. Before commencing, I should thank again the Bank of Ceylon, the bankers to the nation, for inviting me to have another seminar covering the important area of the syllabus. Right. Unit number 13, the analysis of financial statements using accounting ratios. Right. Unit number 13, the analysis of financial statements using accounting ratios. Right. The other lessons we learn how to prepare financial statements. The other lessons we learn how to prepare financial statement. The statement of profit or loss and other comprehensive income, the statement of financial position, statement of changes in equity, statement of cash flows, accounting notes and policies. Right. And so in those lessons, we learn how to prepare the financial statements. How to prepare the financial statement. In unit number 13, we analyze these financial statements using accounting ratios. We analyze financial statements using accounting ratios. Right. We'll take three companies. We'll take a few companies. Company, the profit. We'll take three companies. Company A, Company B, Company C and Company D. We'll take four companies they are in the cement manufacturing industry. Four companies. So, the company A, say profit is 40 million rupees. Company A, profit is 40 million rupees. And then the company 2, B, second company, assume profit is 80 million rupees. 80 million rupees. The third company, we assume the profit is 100 million rupees. And fourth company, profit is 200 million rupees. We assume next company, profit is 300 the company, four companies deal in the same industry. Four companies, company A, company B, company C, company D. They are in the same industry. Four companies. The fourth company profit say 200 million rupees. 200 million rupees. Right. Company A, company B, company C, company D. Assume an investor wants to invest his money. Right. Investor wants to invest his money in these four companies. And if the investor wants to invest his money in these four companies, which company he will decide to invest? Which company he will decide to invest? If he looks at these profit details, if we look at these profit details, he will decide company D. Why? It has the highest profit comparatively other three companies. Company A 40 million profit, company B 80, company C 100 and company D you have 200 million profit. Right. Now your selection is to invest your money in company D. Why? It has generated the highest amount of profit. But if you compare this profit with the sales of these respective companies, turnover of these companies, say company A, the turnover is 100 million rupees. 100 million rupees. Company B turnover say 400 million rupees. The company C 1000 million profit and company D 4,000 in profit. So earlier, you look at the profit detail. So you look at the profit detail, selected to invest your money in company D. So we'll compare the profit and sales and see. You calculate profit percentage. The profit percentage. The 40 million profit with 100 million. 40 million profit with 100 million sales. As a percentage, you have 40%. As a percentage, you have 40%. The second company, 80 million profit with 400 million sales. You have a 20% profit. You have a 20% profit. The third company, company C, you have 10% profit. Company D, you have 5% profit. So now see, the earlier you decided to invest your money in company D. Why? It generated you the highest rupee amount of profit. But if you compare this profit, with its sales, the company D, is the company which has the lowest profit percentage. Company D is a company which has the lowest profit percentage. Out of these four companies, the best company is company A. Why? It has generated this profit. It has generated this profit with a low amount of sales. It has generated this profit with a low amount of sales. So that's why we go and analyze the financial statement, right? Without depending on the values. Without depending on the values shown by the financial statements, we go and analyze them. Right? So earlier you decided to invest your money in company D, but now your decision is completely different. So you analyze the financial statements and see what are the best companies to invest. So in this lesson, we are learning how to analyze the financial statement. How to analyze the financial statement. Right. Now, unit number 13, we are discussing how to analyze the financial statement. Right. So question number 1. What are the techniques used for interpreting financial statements? What are the techniques used for interpreting, to analyze the financial statements? Right. To analyze the financial statements, one of the techniques is ratio analysis. We are learning in the syllabus. The second method, you can use cash flow analysis. We don't discuss in our syllabus. Preparation and presentation of financial statement we had in unit number 12. Then you can use comparative financial statements also. You compare your turnover 2019, 20, 21. You compare. Comparative financial statements also we don't have. The next one, the comparative financial statements, ratio analysis, cash flow analysis, comparative financial statements and common size financial statements. That also we don't have in the syllabus. So we are learning ratio analysis. So what are the techniques we can use? Ratio analysis, cash flow analysis, common size financial statements and comparative financial statements. Ratio analysis, cash flow analysis, common size financial statements and comparative financial statements. Those are the techniques you can use to analyze the financial statements. Techniques you use to analyze the financial statement. The ratio analysis, common size financial statement, comparative financial statements and common size financial statement. So question number 2, what do you mean by an accounting ratio? Accounting ratio. And the mathematical relationship between two or more variables we call a ratio. The mathematical analysis relationship among two or more variables we call ratio. Now, what do you mean by an accounting ratio? The accounting ratio means the mathematical relationship among or between two or more accounting data we call accounting ratio. The mathematical relationship between or among few accounting data we call accounting information we call accounting ratio. Right. So question number 3. What are the methods that accounting ratios can be presented? To present accounting information ratio, what are the techniques available? What are the methods that an accounting ratios can be presented? Right. So to present an accounting ratio, you can use now say gross profit 2000. The gross profit of the company is 2000. Sales 10,000. The gross profit 2000, sales 10,000. You can show this as a ratio. The first method, you can show this as a ratio. The gross profit is to sales. The gross profit is to sales. You compare gross profit with sales. The gross profit is 2000, sales is 10,000. You can say 2 is to 5. 2 is to 5. You can say gross profit is 1 is to 5. This as a ratio. This as a ratio. Gross profit 2000, sales 10,000. You can show this as a ratio. The second method, you can show this as a fraction. You can show this as a fraction. Gross profit over sales. Gross profit over sales. Right. The gross profit is 2000, sales 10,000. Gross profit is 2000, sales is 10,000. As a fraction, 1/5. Ratio, fraction. Third method, you can present this as a percentage. You can show this as a percentage. The gross profit over sales. The gross profit over sales into 100. Gross profit over sales into 100. The gross profit 2000, sales 10,000 into 100, 20%. These are the methods you can present your ratios. You can show as a ratio, you can show as a fraction, you can show as a percentage. Any ratio as a ratio, as a fraction, as a percentage. Right? Ratio, fraction, percentage. These are the options available to show you a ratio. Ratio and fraction, percentage. Those are the options you can use to present the ratio. Question number 3 was, what are the methods that can account in ratios presented? You can use as a ratio, fraction and a percentage. So question number 4. Fourth question, with what ratios the calculated ratios be compared? With what ratios the calculated accounting ratios can be presented? And you say gross profit ratio. You say the gross profit ratio. The gross profit ratio say 20%. Gross profit ratio you say 20%. Company has earned a gross profit of 20%. And to get a meaning, to get a proper meaning, you have to compare these ratios. To get a proper meaning, you have to compare this. So this comparison you can compare with your historical information. Right? Your current year gross profit, say 2021 gross profit is 20%, you compare it with 2020, last year, previous year, and you identify whether improvement is there. And secondly, you can compare your competitors' information. You can compare your gross profit with your competitor. You compare and see whether you are above the competitor or whether you are below your competitor. These two areas we are learning here, the syllabus. In addition to that, you can compare with your budgeted or forecasted ratios, and you can compare with your industry ratios. You can compare with your industry ratios, historical ratios, competitors ratios we are learning here. Calculated ratios you can compare with your historical and competitors ratios. In addition, you can compare with your budgeted or forecasted and industries ratio. So question number 5, classify accounting ratios, classification of accounting ratios. Classify accounting ratios. Right. And then in our syllabus, we classify these ratios into 5 areas. We classify our ratios into 5 headings. The first category, you have liquidity ratios. Liquidity ratios. Liquidity, we have 2 ratios, current ratio and quick assets ratio. Current ratio and quick assets ratio. The second category, we have financial stability ratios. Financial stability ratios, where we analyze the capital structure. The financial stability ratios, we have 3: debt ratio, debt equity ratio and interest coverage ratio. Debt ratio, debt equity ratio and interest coverage ratio. And the third area we classify in the syllabus, you have profitability ratios. Profitability ratios, gross profit ratio, net profit ratio, return on total assets and return on equity. Gross profit ratio, net profit ratio, return on total assets, and return on equity. Right. Then we have efficiency ratios. We have inventory turnover ratio, inventory residence period, debtors turnover ratio, and debtors residence period. Inventory turnover, inventory residence period, debtors turnover, and residence period. Right. And the last category in the syllabus, you have investors ratio. Investors ratio. Investors ratio, we have two: earning per share and dividend per share. Earning per share and dividend per share. Right. To classify accounting ratios, we classify into mainly 5: liquidity ratios, financial stability ratios, efficiency ratios, profitability, efficiency, and investors ratio. Liquidity ratios, financial stability ratios, profitability ratios, efficiency ratios, and investors ratios. Right. So question number 6. Right. The following information relates to the following information relates to 5 products. Product A to E, inventory turnover ratio times average inventory, gross profit on cost. The gross profit on cost. Which product generates the highest gross profit? Which product generates the highest gross profit to the company? Right. And to answer this question, you can calculate gross profit of each product. You can calculate the gross profit of each product. The sufficient details you have. The product, inventory turnover ratio, average inventory, and gross profit on cost of. The cost mean cost of sales. On cost mean cost of sales. Right. Which product generates the highest gross profit to the company? To calculate it. Right. If you take, you have 4 products. You have 5 product. Then you can calculate cost of sales. Cost of sales. If the percentage given, gross profit on cost. The gross profit percentage and gross profit, you can calculate the value. So you have 5 products. The product A, product B, product C, product D, and product E. You have 5 products. The product A, product B, C, D, and E. Right. Then you can calculate cost of sales. How? The inventory turnover ratio is given. Inventory turnover ratio is given. How you calculate? Inventory turnover ratio equal cost of sales divided by average inventory. Right? Inventory turnover ratio is given. How you calculate inventory turnover ratio? The inventory turnover ratio equal, say inventory turnover ratio, cost of sales divided by average inventory. Company's inventory turnover ratio is equal cost of sales divided by average inventory. We'll take product A. If you take product A, inventory turnover ratio is given as 8. Inventory turnover ratio is given as 8. Average inventory is 1000. Average inventory is 1000. And you can calculate what is the cost of sales. Cost of sales value you can calculate. The cost of sales value you can calculate. Then the product A, cost of sales is 8,000 rupees. 8,000 rupees. Just similarly, you can calculate for other two products. In the same way, you can calculate for other two products. Other 4 products B, C, D and E. To calculate cost of sales for product B, C, D and E. To calculate product B, inventory turnover ratio is 6. You multiply by average inventory. To calculate now you got now cost of sales 8,000, 6,000, 4,000, 2,000 and 5,000. 8,000, 6,000, 4,000, 2,000 and 5,000. Right. In the question, last column in the table, last column it's given gross profit percentage on cost. Gross profit percentage on cost. Here it's given here to 15%, 15% and 30%, 25%, 20% and 35%. Those are percentage on cost. Those are percentages on cost of sales. 15, 30, 25, 20 and 35. Then you can calculate gross profit rupee values. You can calculate gross profit in 1000 rupees, 1000. How? In the table it says gross profit percentage on cost of sales. Gross profit percentage on cost of sales. Cost of sales 8,000 into 15%. So 8,000 into 15%, 1,200. 1,200. Now the calculate for other 3 products. Same way you can calculate for other 3 products. 6,000, 30%. 6,000 into 30% to calculate. To compare your calculation with the 1200, 1800, 1400, 1750. So these are the values: 1200, 1800, 1400 and 1750. 1750. Now read the question. Now read the questions. Which product generates the highest gross profit to the company? Which profit generate you the highest gross profit to the company? To compare and see. The product A 1,200,000, product B 1,800,000, product C 1 million rupees, D 400,000, E 1,750,000. Out of the given calculations you made, product B generated the highest gross profit. Out of the calculations you made, you identify product B. Product B is the profit that generated you a higher amount of gross profit. Right. Higher amount of gross profit. And you can answer the product A, product B, product C, product D and E. Out of these products, based on our calculations, we got the answer as 1,800,000. So product B has the highest profit. Answer is answer number 2. Answer number 2, product B. Right. To go through these information given, to use the following information to answer question number 7, 8, 9 and 10. The first point, the relationship between current assets and current liabilities. The relationship between current assets and current liabilities is 5:4. 5:4. If current asset is 5, the current liability is 4. If your current assets is 5, current liability is 4. Right. The second point, working capital. Working capital of this company is 100,000 rupees. The working capital of this company is 100,000 rupees. How can you calculate working capital? The current assets minus current liabilities. The difference between current assets and current liabilities we call working capital. The difference between current assets and current liabilities we call working capital. Current assets minus current liabilities is the working capital. It's the working capital. It is 100,000 rupees. Right. Next point, the closing equity of the business was 20/4 times on current liabilities. If you know the current liabilities value, once you calculate the value of current liabilities, your closing equity is 20/4 times. Once you calculate your current liabilities, that into 20 over 4 times is 20 over 4 times mean 20 over 4, 5 times equal closing equity. Right. The next one, the non-current assets as at 31st March 21 was lower than by 200,000 when compared with 2 times of your closing equity. If you take your non-current assets equal when compared with 2 times of closing equity into 2 times minus 200,000. Your non-current assets equal closing equity when you multiply it by 2 minus 200,000 is your non-current asset. Closing equity into 2 times minus 200,000. Right. So we'll go ahead with the next page. So with that we have questions. What were the values of current assets and current liabilities? So based on the information given, what were the values of current assets and current liabilities as at 31st March? So we'll make the calculations. So based on the information, basic information, you can make the calculations. Right. And if you draw the statement of financial position of this company, you can graph the statement of financial position of this company. Based on the information given, you can draft this statement of financial position, then you can get values for your calculations. Right. So what are the main items? You have non-current assets. And current assets, equity, non-current liabilities and current liabilities. You have non-current assets, current assets, equity, non-current liabilities and current liabilities. Right. We'll go back to the information given. Right. The relationship between current assets and current liabilities. Current assets and current liabilities is 5:4. The relationship between current assets and current liabilities 5:4. The working capital. How you calculate? The working capital equal current assets minus current liabilities. Current assets minus current liabilities we call working capital. In this company, the working capital, the gap between current assets and current liabilities, is 100. Right? So you can calculate the value of current assets and current liabilities now. This into 5 times current assets, this into 4 times current liabilities. 100 into 5 times current assets, that is 500. 100 into 4 times current liabilities, 400. In the financial position, now you can complete 2 values, current assets and current liabilities. The current assets how much? current assets 500, current liabilities 400. As the working capital was 100, that into 5 times your current assets, that into 4 times your current liabilities. Now we calculated our current assets and current liabilities. This is, we are preparing the statement of financial position, using main elements. Right. We'll go ahead with the other points given. Right. The next point, third point, read it. Third point. The third point, the closing equity of the business was 20/4 times on current liabilities. Your closing equity, so equity equal 20/4 times of current liabilities. 20/4 times of current liabilities. We found current liabilities. How much? 400. 400. That into 20/4 times. Your equity equal current liabilities into 20/4 times. Then how much? Your closing equity is 2000 rupees. Your closing equity is 2000 rupees. Now closing equity value also we found. The closing equity value we found, that is 2000 rupees. The closing equity of this entity is 2000 rupees. Now we found current assets, equity, non-current liabilities. Right. The next point, read it. The fourth point given. The non-current assets as at 31st March 21 was lower than by 200,000 when compared with 2 times of closing equity. The non-current assets as at 31st March was lower than by 200,000 when it compared to the closing equity. Right. And we calculated closing equity already. We already calculated closing equity. Right. So how much is the closing equity? The closing equity we calculated as 2000. 2000 is your closing equity. Equity is 2000 rupees. But the question says the non-current assets as at 31st March was lower than by 200,000 when compared to closing equity. The non-current assets equal equity 2 times lower by 200. When compared with your equity into 2 times, once you minus 200,000, then you get your closing non-current assets. The 4,000 minus 200. 3,800 is your non-current asset. The non-current assets. Non-current assets equal 2,000 your equity into 2 times minus 200,000. So your non-current assets 3,800,000 rupees. So 3,800,000 rupees. 3,800,000. And you can total it. Non-current assets, current assets, it comes to 4,300,000. 4,300,000. Same value should be here. Same value should be equity and liabilities also. 4,300,000. You can remember basic accounting equation. Second lesson we learn assets equal equity plus liabilities. Then you can calculate missing value here. You can calculate the missing value. Non-current liabilities value you can calculate. The non-current assets value. So non-current liabilities value you can calculate it. Non-current liabilities 1,900,000. Your non-current liabilities value 1,900,000. So what we did here, using the information given in the question, we prepared the statement of financial position. We drafted the statement of financial position. Now you can answer the question. So now you can answer the question. So question number 7. The question number 7. So question number 7. What were the values of current assets and current liabilities? Current assets and current liabilities. In the financial position, current assets 500,000, we did in thousands. Current assets 500,000, current liabilities 400,000. The current assets 500,000, current liabilities 400,000. The answer number 2. Current assets 500,000, current liabilities 400,000. Current assets 500,000, current liabilities 400,000. Answer number 2. The answer number 2. The current assets and current liabilities. So question number 8. So also question number 8 wanted. So what is the value of non-current assets? Non-current assets. The non-current assets value. The non-current assets value we calculated 3,800,000 rupees. 3,800,000 rupees non-current assets value. 3,800,000 rupees. The answer number 5. 3,800,000 rupees. Value of non-current assets 3,800,000 rupees. So question number 8, answer number 5. Non-current assets value 3,800,000. So question number 9. To go through it, what is the value of total assets? What is the value of total assets as at 31st March 21. 31st March 20, closing assets. So we'll go back to our calculations. To go back to our calculation, total assets. The total assets 4,900,000 rupees. Our total assets 4,300,000 rupees. Non-current assets 3.8 million. Current assets 500,000. Addition came to 4,300,000 total assets. The total assets are 4,300,000 rupees. 4,300,000 rupees. The answer number 3. Third answer 4,300,000 rupees. Total assets value. So question number 10. Question number 10, based on same information, to go through it. So what is the net profit of the business if the opening equity and drawings for the year were 700,000 and 100,000 rupees? What is the net profit? You have to calculate the net profit. Assuming opening equity 700,000 rupees, drawings 100,000 rupees. They have to calculate opening profit for the year. They have to calculate profit for the year, assuming these details. Right. And to calculate the profit, you can use the income statement approach, or you can use the profit equation, net assets approach. Here, income expense details are not given. As income and expense details are not given, we can use the net assets approach to calculate the equity. Right. The profit or loss equal closing equity minus opening equity minus additional capital plus drawings. The profit equation. Right. The profit equal closing equity minus opening equity minus additional capital plus drawings. Right. And if you go back to the question, here you have opening equity 700,000 and drawings 100,000. The opening equity 700,000, drawings 100,000. Right. And you can remember, if you check your work in, we drafted the financial position. There, closing equity we calculated 2,000. You calculated that as 2,000. If you forget how to calculate this, we calculated current liabilities into 20 over 4 times. We calculated the closing equity this way. Current liabilities into 20 over 4 times. 20 over 4 times is your closing equity. So there is no information on additional capital. So no information on additional capital. Then you can calculate a profit 2,000 minus 700, 1,300 plus 100, 1,400,000 rupees. closing equity minus opening equity minus additional capital plus drawings. You get a net profit as 1,400,000. Your profit is 1,400,000. To see the answers given, the answers given 1,400,000 you have in the fifth answer. The answer number 5, profit is 1,400,000. Profit is 1,400,000. So question number 11. So go through it. The following statements have been made based on ratios used to measure the financial stability. Financial stability. The financial stability, a capital structure, we are mainly discuss debt capital and equity capital. Right? You have financial stability ratios in the syllabus: debt ratio, equity ratio, and interest cover ratio. Financial stability ratio, we learn the capital structure of the company. Debt capital, owner's equity capital. Usually business can be financed through debt and equity. This is about financial stability. A statement A. Statement A. A statement A. The debt ratio shows the debt capital as a percentage of debt capital as a percentage of total capital. So how you calculate debt ratio? Debt capital over total capital into 100. How you calculate debt ratio? Debt capital over total capital into 100. We'll read it. The debt ratio shows the debt capital, correct, as a percentage of total capital. The statement A is correct. A statement B, statement A, we can finalize as correct. The statement B, lower amount of debt is identified as high gearing. High gearing. The gearing situation. Right. So what do you mean by gearing of a company? Gearing of a company. So when you compare the company's debt capital, company's capital, we classify as debt. We classify as debt capital and equity capital. Company's capital mainly consists of debt capital and equity capital. Company's capital structure mainly consists of debt capital and equity capital. When compare your debt and equity, if your debt capital is greater than, when your debt capital is greater than equity, we identify that as a high geared company. High geared company. Debt is more than equity. Right. And when you compare your debt and equity, if your equity is more than debt, when your equity is more than debt, we call high geared situation, low geared situation. When your debt is more than equity, it's high geared company. Debt is less than or equity is more than your debt, we call low geared company. In a high geared company, debt is more, low geared company, equity is more. High geared debt is more, low geared equity is more. Right. To go to the statement. Lower amount of debt is identified as a high gearing situation. Right? High gearing situation. We'll go back. Low amount of debt. Low debt means low geared. High debt means high geared company. Then the statement, lower amount of debt is identified as a high geared company. No, the other way. Lower amount of debt is low geared company. The lower amount of debt is low geared company. So the statement B is incorrect. Why? Low amount of debt, low geared. High amount of debt, high geared. The statement is false. To read the statement C. Statement C. Read it. Lower value of interest coverage ratio shows high security of creditors. The lower value of interest coverage, right, interest ratio. Right. And this question is a good question. In the syllabus, you have 3 financial stability ratio, debt ratio, debt equity ratio, and interest cover ratio. It addresses everything. Lower value of interest cover ratio. Interest cover ratio, what we do? Interest cover ratio, we learn whether your profit is sufficient to pay your interest. Why? Interest is a compulsory payment. Interest is a compulsory payment. Right. In this interest cover ratio, we identify whether your profit is sufficient to cover your interest. Right. Whether your profit is sufficient to cover the interest. But what it says here, the low value of interest coverage ratio shows a high security. No. Interest cover ratio is low means higher interest, low profit. Interest cover ratio is low mean. Interest cover ratio low means higher interest, low profit. It is not good for a company. Then your creditors at risk. Your creditors at risk. Low value of interest coverage ratio shows a high security of creditors. Then the statement is false. The statement is false. Why? We expect to have a higher amount of interest. We expect to have a higher value for this interest coverage ratio, which means your profit is more. Right. Then we read the requirement. Right. Identify the answer which shows correct interpretation of financial stability ratios. Right. To identify the answer which shows the correct interpretation of financial stability. Right. Out of the statements, statement A only correct. Statement A only correct. Answer number 1. Only statement A is correct. The answer number 1. Out of the answers given, out of the statements given, only the first statement is correct. Statement A. The answer number 1. The answer number 1 is correct. To read this question. The following information relates to a retail shop for a period of 12 months period. For a period of 12 months. Do you have opening inventory, closing inventory, and purchases? With this information you can think. With this information you can think. Out of the information given, what you can find? Cost of sales. Yes, cost of sales you can find. How? The opening stock plus purchases minus closing stock. Using the above information, the retail shop arrived as a gross profit of 7,800,000. 7,800,000. However, it was later revealed that the closing inventories were overstated. With these details, you have earned a gross profit of 7,800,000. 7,800,000. But it was later revealed that closing inventory overcast by 200,000. The closing stock or closing inventory or closing stock overstated by 200,000 rupees. And opening inventory, opening stock undervalued, understated by 200,000, understated by 400,000. Closing stock overstated by 200,000 and opening stock understated by 400,000. Based on these opening inventories and closing inventory values, the company has earned a gross profit of 7.8 million rupees, 7,800,000. But later on, you found these two mistakes. So what are the mistakes? Closing inventory overstated, opening inventory understated. Right. And we will check what the question requires. The question requires the correct gross profit ratio. Question requires you to calculate correct gross profit ratio. Correct gross profit ratio. So how can you calculate gross profit? The gross profit ratio is equal. The gross profit ratio is equal gross profit over sales into 100. Gross profit ratio, how you calculate? Gross profit over sales into 100. Gross profit over sales into 100. Gross profit ratio. Right. We will calculate now. Right. And using the information given, you can calculate. The question requirement is gross profit ratio. The gross profit ratio, how you calculate? Gross profit over sales into 100. Gross profits over sales into 100. Gross profit as a percentage of sales. Right. Then we want two values. Here we want two variables, gross profit and sales. Right. So based on the information, we can calculate sales. We can calculate sales. And so how can you calculate sales? The sales equal cost of sales plus gross profit. sales equal cost of sales plus gross profit, and the gross profit is given. How much? Incorrect gross profit is given. The incorrect gross profit was given, that is 7,800,000. Incorrect gross profit was given 7,800,000 rupees. The correct gross profit, incorrect gross profit given as 7,800,000 rupees. But this is not the correct gross profit. This is not the correct gross profit based on the values. Right. And the company has arrived at. If you go back to the question, you can identify how they have calculated this. How they have calculated this. They have calculated using this information. You have calculated this gross profit with the amount given. Right. Cost of sales, how you calculate? The cost of sales equal opening inventory plus purchases minus closing inventory. Cost of sales equal opening inventory plus purchases minus closing inventory. Right. The opening inventory, how much? In the question, opening inventory 3,600. 3,600. Then purchases, how much? 8,400. The purchases 8,400. Then the closing stock, closing inventory 4,800. The closing inventory 4,800. Then you can calculate cost of sales. You can calculate cost of sales. The cost of sales you get 7,200,000. To check it's clear, these details: opening inventory 3,600 plus purchases 8,400 minus closing inventory 4,800. Right. You can calculate now. This is the cost of sales. Now you can calculate. Now sales value is 15,000. Sales value is 15,000. Now in the formula, sales value you found the sales value. Now sales value 15,000. Sales value is 15,000. Now the issue is to calculate gross profit. This is to calculate the gross profit. Sales we found. Sales equal cost of sales plus gross profit. Gross profit is given. Then cost of sales, opening inventory plus purchases minus closing inventory. Right. Now the gross profit. Right. Now the gross profit. So how to calculate the gross profit? How to calculate the gross profit? Right. If you go back to the question, the question wants the correct gross profit. Question wants you to calculate the correct gross profit. So this 7,800,000 has two mistakes. 7,800,000 has two mistakes due to the inventory adjustments. So the question, the closing inventory or closing stock The closing stock overstated by 200,000. Closing stock overstated by 200,000 and opening stock understated by 400,000. So these are the errors done by the business. Closing stock overstated, opening stock understated by 400,000 rupees. And we have learned when the closing stock overstate, when the closing inventory overstate, your cost of sales understate, then the gross profit overstated. When your closing inventory overstate, your cost of sales understated and gross profit overstated. Then we can calculate the gross profit. The given gross profit is 7,800. 7,800 given gross profit. Given 7,800 is a given gross profit. Now see, the closing stock overstated by 200. The closing stock overstated mean the profit also overstated. Then you have to minus that 200. Closing inventory. Closing stock overstated means their profit also now overstated. You have to reduce it. You have to deduct it to get the correct profit. Then the opening stock. The opening stock increase means cost of sales increase. Why? In the computation of cost of sales, opening inventory you add the opening inventory. So opening stock increase mean, opening inventory increase mean cost of sales increase. Then what will happen to your gross profit? Gross profit decrease. Gross profit decrease. The closing stock and gross profit positively relate. Closing stock increase mean, the closing stock increase mean your gross profit also increase. Closing stock increase mean your gross profit increase. The opening inventory. The opening inventory increase mean gross profit decrease, negative related. Now what has happened? The closing stock, the opening inventory understated. Opening inventory understated mean cost of sales also understated. Gross profit has been overstated. The error done by the company, opening stock understated. Opening stock understated, profit has been overstated then. In the opening inventory adjustment, we have to minus another 400. Open stock. You can get the correct. The closing stock, gross profit positively related. Opening stock and gross profit negatively related. And so you can calculate the correct gross profit. 7,800 is the given one, plus closing inventory, minus closing inventory 200 and minus opening inventory. The correct gross profit is 7,200. 7,200 you can transfer to our formula. 7,200 here. 7,200 is the correct gross profit. 7,200. 200. Then you multiply by 100 and you get the percentage. You get the percentage. So 7,200 is the correct gross profit, 15,000 is the sales. As a percentage you get 48%. The gross profit ratio is 48%. Right. The correct gross profit is 48%. Answer number 1. Right? Answer number 1. Right? If you want the steps, what we did, we calculated sales. So what we did, we calculated sales using cost of sales and given gross profit. Right. Then for the given gross profit, we make the adjustment for inventory. We rectified, we corrected closing stock overstatement and opening inventory understatement. Right. That's question number 12. So question number 13 and 14 based on the information given. Right. So read it. Right. The following financial information has been provided or extracted from the recent financial statement, financial position of a company. Recent financial statement position of a company. The non-current assets, 150 million. Equity, 150 million. The total liabilities, 25 million total liabilities. So once you read the question, you want to be familiar with the question, then total liabilities. The total liabilities consist of non-current liabilities and current liabilities. Total liabilities consist of non-current liabilities and current liabilities. So when you read the question first time, you can be familiar with the question. You can write this. Then the non-current liabilities 20 million. The non-current liabilities 20 million. So now if non-current liabilities 20 million, the non-current liabilities 20 million, current liabilities should be 5 million. Current liabilities should be 5 million. So what's the value of current assets of this company? So question number 13, what is the value of current assets? So what's the value of current assets? Company's current assets. Right. And again, if you go back to the previous page, the total non-current assets given, and equity and liabilities also given. If you can use here the statement of financial position. accounting equation. To get the values, you can use accounting equation here. Accounting equation. The accounting equation, basic accounting equation. You can remember basic accounting equation. The assets equal equity plus liabilities. Assets equal equity plus liabilities. Right. So now question information. Assets, equity and liabilities given. Equity 150 million, liabilities 25 million. Equity 150 million, liabilities 25 million. The equity and liabilities given. Equity and liabilities given. Assets. Assets. If the assets, non-current assets are given. Non-current assets are given. The assets we divide into two. Assets we divide into two. Non-current assets and current assets. Assets we divide into two. Non-current assets and current assets. So you can write. Instead of writing assets, you can write non-current assets plus current assets. Non-current assets plus current assets. So in the question you have non-current assets. How much non-current assets? 150 million. So non-current assets 150 million equal current assets plus equity and liabilities 175 million. 175 million. Then the current assets equal 175 minus 150, 25 million current assets. 25 million is current assets. Right. We'll go back to the question now. So question number 13. So what is the value of current assets? What's the value of current assets? So we found it. Current assets value is 25 million. Basic accounting equation, we found current assets value 25 million. The value of the current assets 25 million rupees. Out of the answers, 25 million. Its value is given in 1000. 25 million. 25 million is answer. The 13th question, answer number 5, 25 million. 25 million. The 14th question. So read it. Question number 14. What is the value? So what's the current ratio of this company? Current ratio. The current ratio, how you calculate it? The current ratio equal current assets over current liabilities. In a company, we calculate current ratio, current assets over current liabilities. The current assets over current liabilities. Right. And here current assets we found as 25 million rupees. Current assets we found as 25 million rupees. Now the current liabilities. Current liabilities. The current liabilities of this company. So here you have total liabilities. You have total liabilities. The total liabilities consist of non-current liabilities and current liabilities. Right? In a company, total liabilities consist of non-current liabilities and current liabilities. So here non-current liabilities given as 25 million. Then what's current liabilities? The non-current liabilities given. The non-current liabilities given as 25 million. The total liabilities given as 25 million. Now the current liabilities we can find. So in this company, total liabilities 25 million. Total liabilities 25 million. Total liabilities 25 million. The total liabilities 25 million, it includes non-current liability 20 million. The non-current liability 20 million is given. Then the balance will be current liabilities. Balance will be current liabilities. Total liabilities given as 25 million. 25 million. Current liabilities 20 million. Then the balance should be of 25 million of total liabilities, non-current liability 20. So the balance should be current liabilities. Balance should be current liabilities. The total liabilities consist of two, current and non-current. The non-current liability is given as 20. Then the balance should be current liability. The balance should be current liability. Then the current liability is how much? 5 million rupees. Current liability is 5 million rupees. How you got 5 million rupees? Total liability is 25 minus non-current liabilities. Total liability is 25 million minus current liabilities 20 million. And the current ratio is 5. In this company, current ratio is 5. In this company, current ratio is 5. We calculated 14th question. What is the current ratio of this company? Current ratio of this company. The current ratio we calculated as 5. Current ratio is 5 times. Then the answer for the 14th question is current ratio is 5 times. Current ratio is 5 times. So question number 15. So go through it. Question number 15. the total sales of this company business, total sales 720,000 rupees. The total sales 720,000 rupees. The sales of third and fourth quarters were 2 times over the sales of the first and second quarters. Total sales of the entity is 720. The sales of third and fourth quarters were 2 times over the sales of the first and second quarter. If you take first and second quarter sales, first and second quarter sales as X, third and fourth quarters sales should be 2x. Total sales of this company is 720. Total sales of this company is 720. The first and second quarter sales, if you assume as X, third and fourth quarter should be 2 times, 2x. Then the x plus 2x, total sales is 720. That is clear. First quarter x, that into first and second quarter x, third and fourth quarter that into 2x should be equal to 720. The gross profit ratio of the first and second quarter is, the first and second quarter, the gross profit is, they maintain a gross profit ratio of 20%. 20%. And it was 25% on sales in the third and fourth quarter. Third and fourth quarters, the gross profit ratio is 25% on sales. 25% on sales. What's the requirement? Calculate the total gross profit. So you have to calculate the total gross profit of the business. So how can you calculate? If you know separately, if you can calculate separately sales for the first and second quarter and third and fourth quarters, you can calculate gross profit. Right. And we'll use calculations. The total sales given as 720,000. The total sales 720,000. This consists of first, second, third and fourth quarters. This 720,000 include first, second, third and fourth quarters sales. Right. And if you go back to the question, the first and second quarters, the first and second quarter sales we assume as X. Right. The first and second quarter we assume as X. We assume as X. Then third and fourth quarters. Third and fourth quarter sales we assume as 2x. This third and fourth quarters we assume as 2x. 2x. Now the total sales. The total sales should be equal to 720. 720. X plus 2x should be equal to 720. X means first 2 quarters, 2x means second 2 quarters. 720. Right. Then you can calculate value for x. 3x equal 720, x equal 720 divided by 3. 720 divided by 3. 240. X equal 240. X equal 240,000. In the first 2 quarters sales 240,000 rupees. Then calculate second 2 quarters. X equal to 40, then the x into 2, x into 2. Second 2 quarters, x into 2, 480. X were first 6 months, first and second quarter sales, x 240, then the third and fourth quarters, 2x 480,000 rupees. 480,000 rupees. The total sales is 720,000 rupees. 720,000 rupees. Then we'll go to the question. To ask the question requirement. Calculate the gross profit for the year ended. Calculate the gross profit for the year ended. So how can you calculate gross profit for the year ended? So here previously first and second quarter their profit percentage is 20%. Profit percentage is 20%. Second and third quarter profit is 25%. Then here this into 20% profit to this into 25% profit. 25% profit. How can we say the gross profit in first 2 quarters 20%, second and third quarters 25%. You can calculate the gross profit and get the total gross profit. Right. To calculate. $240 into 20%, 48,000. 480 into 25%, 120,000. Then the total gross profit is 168,000. 168,000. How we calculated? We separated sales to first 2 quarters and second 2 quarters. First 2 quarters you got 240,000, second 2 quarters 480,000. Their profit percentages are different. Their profit percentages are different. Why? First and second quarter 20%. The first and second quarter 20%. Third and fourth quarters 25%. 25%. The total sales 168,000. total gross profit 168,000. We separately calculated. Total sales of the company was 720,000. We separated to the first and second quarters, third and fourth quarters. Separately we calculated the gross profit. Why? They have different profit percentages. They have different profit percentages. First two quarters 20%, second and third and fourth quarters 25%. Total profit is 168,000 rupees. The profit is 168,000 rupees. Total gross profit for the year is 168,000 rupees. 168,000 rupees is the total profit. So question number 16. State 4 areas for a business that would be measured by accounting ratios. The areas you can address through accounting ratios. Right? And you can identify liquidity of the company. Liquidity, how you manage your current assets and current liabilities. The area liquidity you can address through or measure through accounting ratio. The secondly, you can identify how you your equity, right? How you manage your or how your financial stability. You can identify how you finance your business and how you're stable, whether you're financially stable. Financial stability you can address or measure through accounting ratio. And you can identify how this company is efficiently running, the efficiency of the company, efficiency ratios. Then you can identify the profitability of the company, profitability. You can measure the profitability of company. And being an investor, you can address or measure the investor side. Investor side, dividend payment and profit for the shares. Okay. So mainly you can identify liquidity, financial stability, profitability and efficiency, and the investors return. Investors, how much they pay dividend and how much they get per share, earning per share. Those are the areas you can address through accounting ratios. To question number 17. To go through it. The two ratios of a company for the year 20 and 21 are given. By using these ratios, state observations regarding the financial policy. In the syllabus, we have financial stability ratios. They have compared debt with total assets. 2020 and 21. When you compare your debt, so when you compare your debt with your total assets, of your total assets 20% in 2020 you have debt. Out of your total assets you have financed through debt 20%. The 21 it is 40%. the debt ratio compared to total assets stood at 20% in 2020 has gone up to 40% in 2021. What you can understand here, the company has obtained more debts. The company has obtained more debt to finance its assets. See the interest cover ratio. The interest cover ratio last year it was 40%, 40 times. Your profit was sufficient to cover your interest. Your profit was sufficient to cover your interest 40 times in 2020. But 21 it has reduced to 20 times. It has reduced to 20 times. But you can observe, debt ratio has gone up when you have obtained more debts. As a result, your interest expense has gone up. As a result of obtaining more loans, your interest cover ratio has gone up, your interest expense has gone up, and the profit has dropped. So what are the observations? You can identify this company has financed its assets using more debts in 2021. The company has obtained more debts. The company has obtained more debts and interest expense has gone up. Interest expense has gone up compared to previous year. More interest expense. Why? You have obtained more debts to finance your asset. You have obtained more debts to finance your assets. So, company has obtained more debts and interest expense has gone up. Right. So, question number 18. To go through the question. When a creditor is settled by cash, you have settled creditors by cash. What is the impact? Impact means increase, decrease or no change. On what? Current ratio and quick ratio. When a creditor is settled by cash, when a creditor is settled by cash, what is the impact? Increase, decrease or no change on the current ratio and quick ratio of the company that pays money. When you settle your creditors, what will happen to your current ratio and quick assets ratio? The given ratios, current ratio 2 times and quick ratio 1 time. Right. And this type of a situation, without giving direct answers, you can make a small calculation. You can make a small calculation and build up your answers. Without giving direct answers, but you can make a small calculations and see. You can make small calculation and see how it happens. The current ratio, quick assets ratio. Current ratio and quick assets ratio. The current ratio, how you calculate? The current ratio, current assets over current liabilities. Current ratio equal current assets over current liabilities. How much is? Current ratio is 2. The current ratio is 2. you can say, you can assume current assets 2000, current liabilities 1000. You can take random figures to be equal to 20,000 divided by 10,000, 2,000 divided by 1000, or 20 divided by 10, any amount you can take to be equal to 2. Then the next, quick ratio and current ratio and quick ratio. The quick ratio, how you calculate? The quick ratio, how you calculate? Quick assets divided by current liabilities. Quick ratio, quick assets, how you define? Quick assets is current assets minus inventories minus prepayments. Quick assets mean high liquid assets. Inventories and prepayments you exclude from current assets. Quick ratio, what they say? Quick ratio is 1. Quick ratio is 1. So in this ratio, quick ratio is 1 mean quick assets and current liabilities 1000. Not like a calculation questions. This question, this type of a question, best thing is write the formula and substitute random values. Substitute random values. They are given ratios 2 and 1. 2 and 1. Right. What's the question says? When the creditors are settled. Right. When the creditors is settled. Right. Creditors settled. Right. Assume you have paid 500 to creditors. Right. You paid 500 to creditors. What's a double entry? Creditors control account debit, creditors debit, and cash control account credit. When you pay creditors 500, creditors control account debit means creditors decrease. Creditors decrease. Cash control account, cash also decrease. When you settle your creditors, double entry cash debit, cash credit, creditors debit, creditors decrease, cash decrease. Creditors decrease, cash decrease. The creditors decrease mean current liabilities decrease. How you relate to our question calculations? Creditors decrease mean current liabilities decrease. The cash decrease mean current assets decrease. The creditors decrease mean current liabilities decrease. Cash decrease mean current assets decrease. Then to calculate. Now say you pay 500 to your creditor. You pay 500 to your creditor. Take current ratio minus 500. Cash is a current assets. The cash is the current assets minus 500. The creditors current liabilities. Cash current assets. Creditors current liabilities. The 1500 1500 divided by 500, then 3. When your creditors decrease, your current liabilities decrease. When your cash decrease, current assets decrease. You paid 500 to creditor. You paid 500 to creditor. 3. Right. Then the take the impact on quick ratio, quick assets. Except inventories and prepayments, all current assets are quick assets. Except inventories and prepayments, all other current assets we consider as quick assets. Then the cash decrease. The cash decrease means current assets decrease. The cash decrease means current assets decrease. The 1000 current liabilities. Creditors decrease 500. Now the 500 over 500 1. You can build up your answer now. What happened to your current ratio? Earlier it was 2. It was 2. Now it is 3. Earlier it was 2. Now 3. Earlier current ratio was 2, now 3. Then the current ratio increased. Current ratio increased. So take your quick assets ratio. Quick assets ratio earlier 1. Earlier 1. Earlier 1. So now also 1. Earlier 1, now also 1. So what happened? Quick ratio, no change. The quick ratio, no change. Earlier and now, both same. Earlier and now, both same. Right. And you can write the answer. Right. You can write the answer. The current ratio. The current ratio. The current ratio earlier 2, now 3. The current ratio increase. The current ratio increase. Then quick ratio, no change. Earlier and now both 1. Your answers, current ratio increase, quick ratio no change. The current ratio increase, quick ratio no change. So question number 19 to 21. 19 to 21. To read them. To go through it. The following information has been provided by a business. Stock turnover ratio, inventory turnover ratio, how you calculate? Inventory turnover ratio, cost of sales divided by average inventory. Debtors turnover ratio, credit sales divided by average debtors. Sales for the year, operating expense, average inventory and income tax rate. Average inventory, how can you calculate? Opening inventory plus closing inventory divided by 2. The stock turnover ratio equal cost of sales divided by average inventory. Right? Stock turnover ratio equal cost of sales divided by average inventory. So debtors turnover ratio. Debtors turnover ratio equal to credit sales divided by average debtors. Average debtors. The credit sales divided by average debtors. The average inventory, opening inventory plus closing inventory divided by 2. Opening inventory plus closing inventory divided by 2. The tax rate 40% on profit before tax. 40% on profit before tax is the income tax rate. Right. Those are the information given. You have 3 questions based on the information. What is the gross profit? Gross profit. What's the gross profit of the business? Gross profit. What is the profit before tax? Net profit ratio. Gross profit for the year, profit before tax, and net profit ratio. We'll calculate them. We'll calculate. They have to calculate gross profit. They have to calculate gross profit, profit before tax, and profit, net profit ratio. Net profit ratio. Right. The sales for the year given. Right. The sales for the year is given. Right. Inventory turnover, stock turnover ratio also given. Sales and inventory turnover ratio given. Right. The gross profit we can calculate using the sales and cost of sales. Right. You can use sales and cost of sales to calculate the gross profit. Right. The question number 19. The question number 19. Was the requirement? Question number 19. Gross profit calculation. The gross profit calculation. Gross profit. We'll calculate it. And as the question has given you sales. As the question has given you sales and cost of sales. The question number 19. The gross profit equal sales minus cost of sales. Gross profit equal sales minus cost of sales. The sales for the year. The sales for this given. Sales for this 2,400,000. The company sales 2,400,000. Cost of sales. The cost of sales. The inventory turnover ratio is given. 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 Stock turnover ratio is given. Right. The stock turnover ratio, sales given. Stock turnover ratio. Stock turnover ratio is given. How you calculate inventory turnover ratio? The inventory turnover ratio, these 3 equal cost of sales divided by average inventory. Inventory turnover ratio is equal cost of sales divided by average inventory. Cost of sales divided by average inventory. The average inventory is given here. 3 equal average inventory 600,000. Then you can calculate cost of sales. You can calculate cost of sales. Inventory turnover ratio is 3, which is equal cost of sales divided by average inventory. Then the cost of sales how much? Cost of sales 600 into 3, 1,800. Cost of sales 1,800, 1,800,000. 1,800,000. Then the gross profit is 600,000 rupees. Your gross profit is 600,000 rupees. The answer for the question number 19, gross profit is 600,000 rupees. The rupees 600,000 is the gross profit. The gross profit is 600,000 rupees. So question number 20. Question number 20. 19th question we calculated gross profit 600,000. The 20th question, profit before tax. The profit before tax. Right. So in the information, sales given and we calculated gross profit, operating expense also given. Operating expense also given. Right. What's the question requirement is profit before tax. The profit before tax. Profit before tax. Right. We'll make the calculations. Now we have gross profit. We have gross profit. We have gross profit how much? 600,000. We have gross profit of 600,000. Now question number 20. 20th. Question number 20th we have to calculate profit before tax. Profit before tax. The gross profit we calculated. How much? 600,000. Gross profit 600,000. For that usually we add other income. There is no other income. There is no other income given in the question. There is no other income given in the question. Do you have only operating expenses? Do you have operating expenses? How much operating expenses? It's 200,000 rupees. Operating expenses was 200,000 rupees. Operating expense 200,000 rupees. You minus right. You get 400,000 as the profit before tax. The profit before tax is 400,000 rupees. Profit before tax we calculate 400,000 rupees. And the answer to question number 19 we calculated 20th question, the answer is 400,000 rupees. The gross profit is 600,000. 19th question. 20th question, profit before tax is 400,000 rupees. Profit before tax 400,000 rupees. Then the question number 21. The net profit for the net profit ratio. Right? Net profit ratio. How you calculate net profit ratio? the net profit ratio equal net profit for the period divided by sales into 100. Profit for the period divided by sales into 100. The profit before tax we calculated. The profit before tax we calculated. Income tax. Income tax, so they say 40% on profit before tax. Income tax is 40% profit before tax. The profit before tax 400,000. 400,000. Then you can minus income tax. Says income tax, they say 40%. Income tax. The 400,000 profit before tax, what it clearly say? Income tax rate is 40% on profit before tax. The 40% on profit before tax. The income tax is 40% profit before tax. It's clear now that income tax is 40% on profit before tax. Now we have already found profit before tax. How much profit before tax? 400,000. The 400,000 into 40%. 400,000 into 40% is 160. Now the profit for the period. The profit for the period is 240,000. The profit for the period is 240,000. Right. Then again we'll check the question requirement. The question requirement is what? Question number 21 requirement, net profit ratio. Net profit ratio. Right. The net profit ratio, net profit is, now we calculated net profit 240. Net profit is 240,000. The sales are given in the question. Sales given in the question as sales 2,400. Sales 2,400. Net profit 240. Profit for the period. Sales 2,400. Sales 2,400 into 100, you get 10% as the net profit ratio. We calculate the profit for the period, and from that you took income tax. After deducting that, you got the profit for the period. You compared it with sales. You compared it with sales, you get 10%. You get 10%, and the answer for that is 10%. Net profit ratio is 10%. Now the answer is clear. 19th question. Gross profit we calculated 600,000. The question number 20, profit before tax, we calculated 400,000 rupees. Net profit ratio we calculated 10%. Now 19, 20, 21. To question number 22 and 23. the working capital of a business change. The working capital means current assets minus current liabilities. Working capital means current assets minus current liabilities. Working capital of this business changed by 80,000. Due to what? Due to receipts of cash from credit customers. The credit customers mean your debtors. Working capital change due to receipt of cash from credit customers. Now assume 100 worth of debtors they pay. 100 worth of your debtors they pay cash. What's a double entry? When debtors pay cash, double entry, cash debit, current assets increase, debtors credit, current assets decrease by 100, decrease by 100. The overall impact, no impact. The working capital means current assets minus current liabilities. Current assets minus current liabilities. Right. Working capital of the company of a business changed due to receipt of cash from credit customers. To check in this situation, the current assets and current liabilities increase, decrease. So working capital zero impact. Zero impact. Why the current assets increase, current assets decrease, no impact. Assume you get 100 worth of debtors, they pay after deducting of discount allowed, they pay 80. They pay 80. Then your cash will increase by 80. Cash increases by 80. Debtors decrease by 100. This is discount allowed. Discount allowed 20. So in this situation, now it's different. In this situation, it's different. Why? Your debtor decreased by 100, current assets decreased by 100, but the current assets, cash, increased by 80. Now there is a difference. Now there is a difference. Earlier, 100 worth of debtors they pay without a discount. But now, you give a discount and you collected 80. You collected 80. Two different situations. The first situation, no impact on current assets. Why? Your debtors decreased by 100, cash increased by 100. Debtors decreased by 100, the cash increased by 100. There you don't have any impact. But in the second situation, the debtor decreased by 100, debtor decreased by 100, cash increased by 80. Discount allowed is an expense. Discount allowed is an expense. Right. Now, what happens here? Right. Your working capital changed due to discount. your working capital change due to discount. Then what is how much discount? This 80,000 is what? 80,000 is discount. The 80,000 is discount. This 80,000 is the discount. Right? That 80,000 is the discount. Your working capital decrease by 80. That is what is your discount allowed. Your discount allowed is how much? 80,000. This 80,000 discount allowed is, this is your discount allowed, and it was 10%. Right? This 10% is 80,000. Discount allowed 10%, that is 80,000 rupees. And that benefit was given to all customers. This 10% benefit you gave to all customers. Discount allowed is 10%, which is equal to 80,000, that was given to all customers. The debtors balance as at 31st December 150,000, and this was equal, this 150,000 equal to 1/4 time of credit sales. Right? If the credit sale was X, that into 1/4 equal debtors balance. If your sales is out of sales 1/4 equal sales, then sales how much? The credit sales 1/4 of credit sales, then the credit sales equal 150 into 4 times 600. Credit sales equal 150 into 4 times. You have two questions. How much was collected from credit customers? How much was collected, cash collected? And what was the debtors balance on 1st January? Opening balances. That is your opening balance. How much was collected from debtors, and what is your opening balance? What is your opening balance? You will make calculations. You can make calculations, and you can calculate this roughly. You can draft a debtors control account. There you can update the information. You can draw the debtors control account, and there you can record the values. Right. You can name this as debtors control account. Debtors control account. Right. And here they are talking about discount allowed, cash collected, closing balance, and credit sales. You have discount allowed, cash collected, carried down balance. Carried down balance, and sales, credit sales. Credit sales. The question 22-23 requirement, how much was collected from debtors? The discount allowed was 80. Discount allowed was 80. Why? This working capital change I explained you, 80,000. then this is 10%. This is 10%. Right? If your total debtors who paid cash, right? If your total debtors who paid cash, if your total debtors who paid cash, the total debtors who pay cash, that into 10% equal 80,000. That into 10% equal 80,000. Now the total debtors who paid cash, now that into cross multiplication, debtors value is 800. 800 worth of debtors paid. 800 worth of debtors paid. For them you have given a discount of 80. 800 worth of debtors they have paid, for them you have given a discount of 80. So how much you collected? You have collected 720. You have collected 720. The cash collection 720. Now you check the question. How much was collected from debtors? How much was collected from debtors? So how much you collected? How much you have collected? We calculated 800 worth of debtors paid with a discount of 80. So you have received cash from 720. You have received cash 720,000. And so that's the answer for question number 22. Answer for question number 22. 720,000 rupees. 720,000 rupees. How much was collected? How much was collected? You have collected 720,000 rupees. You have collected 720,000 rupees. What was the debtors balance as at 1st January? Debtors opening balance. Debtors opening balance. And here it says debtors balance closing date. Debtors balance closing date. Debtors closing date balance. The debtors closing balance given. Debtors closing balance is you have 150,000 closing debtors balance. And you can record it in our control account. The closing debtors balance is 150,000 rupees. The closing debtors balance is 150,000 rupees. Closing debtors balance. The balance carried down is 150,000 rupees. And they say that it is 1/4 time. Right? It is 1/4 time. It is 1/4 time. 1/4 time of credit sales. This is 1/4 time of your credit sales. If your credit sales, the sales into 1/4 equal 150. Sales into 1/4 equal 150. And the sales how much? 150 into 4. Your sales 150 into 4. 600,000. Your credit sales is 600,000 rupees. Now we'll go back to the question. what is the debtors balance? Debtors balance 1st January. The debtors balance 1st of January, you can calculate it. You can calculate the balance. You can calculate the balance. Opening balance. How you calculate? Get the addition of, here you get 950. The 950, you can calculate the missing value. So what is the missing value? 350 is the opening balance. Balance brought forward is 350. Balance brought forward 350,000. Right. Now to your answer for question number 23. Answer for question number 23. How much you got the balance? 350,000 rupees. How much is the balance? 350,000 rupees. 350,000 rupees. Right. The answer for question number 22. Answer for question number 22 is 720,000 rupees. (23) the debtors balance, opening debtors balance 350,000 rupees you calculated. So what you learn here, this working capital. When a debtor pay, so when a debtor pays his amount, cash and if you don't give a discount, no impact on working capital. Why? By the same amount, your cash increase, debtors decrease. Overall, no impact. But when you give a discount, that has an impact on your working capital. So then again, if I revise you the calculations, this discount allowed is 80. It was 10%. Of debtors who pay full money. Right? That was 10% of your total debtors who settle money. Right? With that you can calculate total debtors. Credit sales based on the closing balance. So based on the closing balance, you can calculate your credit sales. And with that you can calculate the opening balance. Of debtors control account. To state two deficiencies of accounting ratios when they are used for prediction process. Right? We calculated ratios, but there are deficiencies. To state two deficiencies of accounting ratios when they are used for prediction process. Right. And for these accounting ratios, we learn profitability ratios, liquidity ratios, financial stability ratios. But these ratios you calculate using the financial statements. You calculate these ratios using the financial statements. Right. And if you take a company, in the financial statements, they disclose minimum information based on the statutory regulations or rules. They disclose minimum information. They disclose minimum information. Why the companies or business entities, they are in a competitive environment. As they are in a competitive environment, they don't want to show all the information in the financial statement. They will show minimum information. As this financial statement shows the minimum information. Based on this minimum information, it's difficult to go for a proper analysis. Proper analysis. Right? One is disclosing of minimum information. That's a deficiency. Right. And the secondly, these financial statements, you prepare companies. The companies may use different accounting policies. Right? Different accounting policies. Depreciation, you have straight line method and reducing balance method. Straight line method and reducing balance method. So based on these depreciation methods, your operational results change. Your operational results change based on your accounting policies. Inventory valuation, so you have FIFO method, WAC method, two different accounting policies. Your inventory value will change. As a result, your operational results, financial position change. The company may be same industry, but they are using different accounting policies. As a result, your operational results and financial position may change. The thirdly, right, and the company's operating pattern. Operating pattern. Right? You don't show your financial statements. Right? Say company A may be using its own permanent staff. Company A may have its own permanent place, its own machineries. But the company B may be having company B may have contract staff and rented machineries, rented business place. Right? Company A has its own resources, staff, premises, machineries, everything. Company B rented. If you compare A and B, the company A, even though it has a lower profit percentage, it is strong than company B. Why? It has its own staff, it has its own machineries, its own premises, then operating pattern also you have to identify, but in ratio analysis you don't consider them. And the next one, company's history. Company's history. The company's history is not shown by the financial statements. Right? Company's history is not shown by the financial statements. Right? Now, for example, your company has been doing business say for 15 years. Your company has been there in the business for 15 years. But your competitor who just joined the business, just entered the business, even though it has a good profit, but you have a history, your company has a history, then you are more stronger than your competitor who has the highest profit percentage. By you have a customer base, you have been doing business for 15 years, then you have a good customer base. So company's history also we have to consider in the analysis of financial statements. You have to consider a company's history in the analysis of financial statement. Right. Those are the deficiencies in ratio analysis. Deficiencies in ratio analysis. Right. So question number 25. Right. So question number 25. State whether the following would lead to an increase in the net profit ratio. Increase in net profit ratio of a trading company in the current year compared to previous year, while the gross profit remain constant. The question is, state whether these factors would lead to an increase in the net profit ratio of trading company in the current year compared to the previous year, remaining gross profit unchanged. Right. In answering this type of a question, without giving direct answers, you can use the factors in the formula. You can use the factors in the formula. Increase in the net profit ratio. In the net profit ratio. And how can you calculate the net profit? Right? Net profit equal the profit for the period divided by sales into 100. Right. This is how you calculate the profit. Right. The profit divided by sales into 100. Profit for the period after deducting taxes. The profit for the divided by sales into 100. Right. The first one, net realizable value is higher than the cost. Right? Net realizable value is the higher than the cost. Right. And in the inventory valuation, when the cost is greater than net realizable value, you identify as the inventory loss, which is an other expense. So when your cost is greater than the net realizable value, we identify as inventory loss. Right? And our question, the net realizable value higher than the cost. Net realizable value is higher than the cost. NRV higher. NRV higher means you have inventory gain. Inventory gain we don't recognize. Then no impact for these factors. Right? No impact for these factors. Inventory gain we don't recognize. Then it has no impact. Right? It has no impact. You can write the no. Why? Inventory gain we don't recognize, so it has no impact on these two variables. Right. Question is whether increase. The increase in interest expense. Right. We got the formula, profit for the period divided by sales into 100. Profit for the period is divided by sales into 100. Right. Then the interest expense. Right? Interest expense. The interest is an expense. The interest is an expense. Due to expense, your profit decrease. Right? Due to expense, your profit decrease, has an impact. Profit decrease. Due when your interest expense, right? When your interest expense increase in interest expense, so interest expense increase mean the interest expense increase mean profit decrease. Right? The profit decrease. But question is whether net profit ratio increase. Due to increase in interest expense, net profit ratio decrease. Then the question requires increase in net profit. Increase in net profit. Answer no. Answer no. Right. To see revaluation of buildings at a gain for the first time. Gain for the first time. The first time gain, where you record? Right? The first time revaluation gain you record under other comprehensive income. First time revaluation gain you record under other comprehensive income. Then you can remember in the statement of profit or loss and other comprehensive income. Right? In the statement of profit or loss and other comprehensive income, you have profit for the period. Profit for the period. Then you have other comprehensive income, revaluation gain. Then only you get total comprehensive income. The profit for the period, other comprehensive income, revaluation gain. The revaluation gain first time revaluation gain you adjust under other comprehensive income. Right? So then it has no impact on profit for the year. Right? It has no impact on profit for the year. Why? It has no impact on profit for the year. Why? Revaluation first time gain. First time revaluation gain you record under other comprehensive income. First time revaluation gain you record under other comprehensive income. This is other comprehensive income. This is other comprehensive income. So it has no impact. It has no impact. Why? You record this under other comprehensive income. Then the answer is no. Answer is no. Right. D, the last one, the receipt of dividend from long-term investments. You have invested in long-term assets. You have long-term investments. You receive dividend. The receipt of dividend where you record under other income. You record under other income. You record under other income. The dividend received you record under other income. Other income, we will go to our formula. We go to our formula. Net profit ratio, how you calculate? Profit divided by sales into 100. That's a part of other income. Other income is a part of profit. And your profit increase. Profit increase means your net profit increase. Yes. Your net profit increase. Yes. The answer, yes. Answer, yes. Right. Again, state whether the following would lead to an increase of the net profit ratio. Net realizable value higher than the cost mean, you have inventory gain we don't recognize. Increase in interest expense, profit will decrease. But question is whether increase. The revaluation of building at a gain for the first time. The first time gain you record under other comprehensive income. Receipt of dividend you record under other income. Right. And we discuss question by covering the ratio analysis lesson. Right. And in the ratio analysis lesson in the syllabus, ratio analysis lesson. Right. The ratio analysis lesson we identify as unit number 13 lesson. The ratios in the financial statement analysis part. Right. In the financial statement analysis part, we prepare in other lessons. Here we analyze. Right. And there are ratios we classified into 5 groups. Liquidity ratios, current assets, current liabilities to current ratio, and quick assets ratio. Then we discuss the other second category, financial stability ratios. You have 3 ratios: debt ratio, debt equity ratio, and interest cover ratio. Then you have profitability ratios: gross profit, net profit, gross profit ratio, net profit ratio, return on total assets, and return on equity ratio. Then you have 4 efficiency ratios: inventory turnover ratio, inventory residence period, and debtors turnover ratio and debtors residence period. Right. And then finally you have investors ratio, earnings per share, and dividend per share. Right. As a seminar series organized by the Bank of Ceylon under the concept of NanaJaya program, today we concluded the second one, which covers the 13th lesson, ratio analysis. Right. Until we meet a new lesson, we must thank, before winding up, I must thank to Bank of Ceylon for giving me this chance to conduct a seminar series by covering the one section in the syllabus. Until we meet, thank you very much, and bye bye.